Well, I think gold, and it's funny these days when you talk to people about gold, they want to hear about silver also, and I'm sure we could talk about that. But gold and silver are going to go a lot higher. I feel very comfortable with that. There are multiple drivers, and I'll kind of go through them one by one. Yeah, the drop. Yeah, we get 5,500 in about a heartbeat. It was. I was watching the ticker. We're going to get to 5,000. Of course, I knew we would, but when it's 5,000, then I think I went to sleep and woke up. It was 5,500. So I was like a 10% drop. Well, literally in 2 days. So yeah, a little pullback's normal. Hedge funds. I always say hedge fund traders don't care about gold, silver, or coffee beans. They just trade. And so if you're a trader and you do a leverage bet on gold and it goes up 10% in 3 days, you probably want to get out of the trade and, mark it up towards your 2026 bonus. So that kind of volatility is normal, but it doesn't really tell us where to peak or anything of the kind. With that said, so what are the drivers? There are several. One is central bank demand. It's we've talked about that before, but it's a big deal. They from 1970 to 2010, central banks were net sellers of gold. Different central banks at different times, believe it or not, in the 1970s, even after Nixon suspended the convertibility of dollars for gold, the U.S. continued to sell gold. We sold about 1,000 tons over the course of the 1970s, got us from 9,000 tons in 1971 to about a little over 8,000 tons in 1980. Then we got the UK to do our dirty work. There are really technical reasons why the U.S. has not sold any gold since 1980. Probably don't have time to go into them. They're legal and has to do with when the Fed took the gold from the banks, but in the 1930s, the Treasury took the gold from the Fed. So they keep stealing it between themselves. But there are reasons to believe that, the U.S. has not sold any gold since 1980. You sell a little bit to the Denver Mint for coinage and get some more, but they've maintained that official level the whole time. There are reasons to believe that the U.S. cannot sell. Not only is not a seller, but cannot sell legally. So put that to one side. The UK sold about a third, almost half of their gold in the late 1990s, 1998, 1999. They weren't very savvy traders. They sold at $250 an ounce, not $2,500, but $250 an ounce. Practically gave it away. That was Gordon Brown was the Chancellor of the Exchequer. You should see him around London and the Red Fort at different restaurants. That's known as Brown's bottom. He managed to pick the bottom, a 30-year bottom of the market. He picked it and sold the gold. But even in the 2000s, Switzerland sold 1,000 ounces, and in 1,000 metric tons. Not ounces, 1,000 metric tons. And then there was an uproar in Switzerland. There was a referendum. It failed, but the people in Switzerland were to the point where they wanted a referendum saying that the Swiss National Bank could not sell any more gold.
For decades, Western central banks were consistent sellers of gold. That era is over. Since the early 2010s, global monetary authorities have become net buyers, led by emerging powers such as China and Russia. This shift reflects changing attitudes toward reserve security, especially after geopolitical asset freezes exposed vulnerabilities in dollar-based systems. With global mine production largely flat, steady institutional buying creates structural support under gold prices. Central banks tend to accumulate quietly during price weakness, effectively placing a soft floor beneath the market. This asymmetric setup limits downside while leaving upside open, an attractive long-term dynamic.
The referendum failed slightly, but the message was sent, and they have stopped selling gold ever since. That brings us to the IMF. The IMF sold 400 tons in 2010. Looks like 200 or so went to India. They never disclosed where the rest went. I'm pretty sure it went to China. But that was it. That was it for large sales by the Western central banks. Since then, central banks have been net buyers. Now, it's not the same central banks. The big buyers have been Russia and China. Russia went from 600 tons in 2009 to about 2,700 tons today. That's, they quadrupled their gold holdings. By the way, just as a quick aside, that's a big reason why U.S. sanctions on Russia in connection with the Ukraine war have failed, because they can never starve Russia reserves, because Vera Nabiullina, who's the head of the Central Bank of Russia, I always say she's the only central bank in the world who really knows her job. She put 25% of Russia's reserves in physical bullion. And at the start of the war in Ukraine in 2022, Russia had about $600 billion in reserves, but 150 billion of that was in gold, physical bullion. The U.S. couldn't touch it. The U.S. and Europe conspired to steal about 200 billion of Russian reserves in the form of treasury notes. Russia they had treasury notes, they had gold, they had some other instruments, some euro-denominated notes, but it was mostly treasury notes and gold. And the U.S. and others tried to steal them. They're in a custodian in Brussels called Euroclear, which is one of the biggest custodians in the world. They have $47 trillion of assets in custody. They don't own it, but they're the custodian, registrar for all that. So that was supposed to be like this death blow for Russia. We froze the reserves. Then we were going to steal them, use them as collateral for a loan to Ukraine. So Russia's lawfully acquired assets are being used as a collateral for a loan to pay Ukraine to fight Russia. That's how crazy this whole thing was. It gets worse, but anyway, Russia's going to win the war. They'll eventually get those assets back. But my point is, why was that not a kind of a death blow to Russia's financial position? Well, a number of reasons, but part of it was because they had so much gold. Ironically, because of the effort to steal the Russian assets, central banks around the world, not just Russia, but others, started buying more gold, and it drove the price of gold up. So Russia has, do a quick estimate, has almost tripled the value of their gold reserves in dollar terms because of the run-up in the price of gold, because the U.S. tried to steal the dollar assets of Russia in Euroclear. So what we did on the one hand, by freezing and trying to steal assets, we gave an enormous $100 billion gift to Russia in the form of higher gold prices. So I think I have to do the math, but my estimate is they've made as much on gold mark to market as they lost in these assets stuck in Brussels. So, and I teach this. I teach financial warfare at the U.S. Army War College. So I try to explain this to the students. They're pretty smart. It's a hand-picked class, about 13. They're all kind of future big brains, or future high-ranking big brains, I should say. But and I got a lot of pushback on it. But when you explain it to people, they're like, "Oh yeah, that was kind of a dumb move." What the U.S. did.
The freezing of sovereign reserves in recent geopolitical conflicts sent shockwaves through global finance. While intended as a punitive measure, it unintentionally reinforced gold's role as a neutral reserve asset. Countries holding physical bullion outside foreign custody discovered a powerful form of insulation. As a result, many central banks reassessed their exposure to paper reserves and increased gold allocations. Ironically, these actions helped push gold prices higher, offsetting losses elsewhere. The episode demonstrated a crucial lesson. Assets without counterparty risk behave differently in crises, and markets have begun repricing gold accordingly.
China, same period, 2009 to today, China's gold reserves have gone from about 600 metric tons to closer to 3,000 metric tons. They very likely have a lot more. They're non-transparent. Well, the People's Bank of China is transparent to a point, but they have another sovereign wealth fund called the State Administration of Foreign Exchange, or SAFE, which holds foreign exchange, including gold, and is completely non-transparent. So we don't know exactly how much gold China has, but there's good reason to believe that this 3,000 tons they report could very well be closer to 6,000 tons or more. So there's China. But you have other buyers: Kazakhstan, Vietnam, Mexico, even the Philippines, India, Japan, which is an ally of the United States, increased their gold reserves. So that does a couple of things. And obviously, it tends to drive the price up, not to stratospheric levels, but to drive it up. But on the other side of that trade, or that equation, is gold output has been constant, around 4,000 metric tons per year worldwide. Now, it hasn't been crashing, and I'm not saying peak gold. You can still find gold, but it's getting more and more difficult. Lower levels, lower grades. I invest in some gold mines, so I'm not a geologist, but I have some familiarity with the kind of the economics of the gold mining industry. But, economics 101, first week, supply and demand. When supply is constant and demand is going up, the price goes up to to clear the market. So that's one of the drivers, and it's really attractive for gold investors. Like by itself, it doesn't mean gold goes to the moon, but what it does mean is you have a kind of informal floor under the price of gold. No guarantees, but if the price goes down a lot, central banks, that's when they come in and nibble because they're pretty savvy buyers. So you have what I call an asymmetric trade where you have all the upside, but limited, in my view, limited downside because the central banks are putting a floor under the gold. So that's a high level dynamic. At the same time, when the U.S. and Europe froze those Russian assets, other sovereign wealth funds and central banks around the world are looking at this. Whether it's Taiwan or Japan or Saudi Arabia, some of these have, if not $1 trillion, close to $1 trillion in reserves. They're saying, hey, what if the U.S. doesn't like something I do? What if they want to treat me the way they treated Russia? Maybe I ought to buy more gold, and they are. I'm not saying they're dumping treasuries. The debasement trade, the narrative from Wall Street is, the world's dumping treasury securities. They're dumping dollars. They're getting out of the dollars. The dollar's over. Buy gold, etc. I agree with the buy gold part, but everything else I just said is false, and we have data to back that up. The Treasury has a monthly report. It's called the TIC report, TIC, but basically it's a very simple spreadsheet. And they show all the major countries around the world, and then they show how much gold they have, how many treasury securities they have. I misspoke. How many treasury securities they have. And that's been fairly steady. I'm not saying the world is loading up on treasuries, but they're definitely not dumping them. That part of the narrative is false. And people talk about the dollar being the global reserve currency. Well, currencies are not global reserves. Global reserves are securities.
Despite widespread claims of de-dollarization, data tells a more nuanced story. Nations are not abandoning U.S. Treasury securities en masse. When treasuries are sold, it's often to obtain dollar liquidity, not to reject the dollar itself. Global reserves are held in securities, not stacks of cash, and demand for dollar-denominated assets remains resilient. The real shift is not away from the dollar, but toward diversification. Gold fits naturally into that strategy. It complements rather than replaces existing reserves, strengthening its role without signaling the collapse of the current system.
And people don't make the distinction between a currency and a security. Now, the security is denominated in the currency, of course, and that's really what people mean. But it's not like the central banks have pallets of $100 bills in the basement. They don't. They have treasury securities, 2-year notes, 5-year notes, 10-year notes, short-term bills, all the different maturities of treasury securities. And they are not dumping them. If they sell any, and sometimes they do, it's more a sign of dollar strength than dollar weakness. And the reason for that is, why would you sell your treasury securities? Well, it means you need cash. Because treasury securities are not, as I just explained, they're not cash. If you want cash, you got to sell the treasuries, get the cash. What is China doing with the cash? They're propping up their banks and propping up their currency. That's not a sign of dollar weakness. It's the opposite. It's a sign of dollar scarcity and weakness in the yuan or the Japanese yen, as the case may be, and all these other currencies. So even to the extent that some of the countries sell a little bit of treasuries, it's more because they're desperate for dollars, not because they're dumping dollars. So the reality is actually the opposite of the narrative. It's still the Great Reset and the end of the dollar and all this stuff. It's just not true. It is true that the price of gold is going up, but for some of the reasons we just mentioned. Beyond that, there's a simple bit of math that accounts for part of what's going on. And here we can introduce, when I say simple, this is 5th grade math. We don't need calculus for this, but we can introduce behavioral psychology. And in behavioral psychology, we're all humans. We all have cognitive biases, many of which have been identified through, pretty good experiments. And one of them is called anchoring. And anchoring means we get an idea in our head, and we kind of anchor on it, and we begin to filter all the evidence through that one idea, through that so-called anchor. And one of them, recently, but very much so now, but in recent years, is we think about the dollar price of gold. and how much gold we have and how much money we made, at least on a mark-to-market basis. So let's just take a very simple example. Let's say you have 50 ounces of gold and gold goes up $1,000 an ounce. Well, you just made $50,000, mark-to-market. Okay. And it goes up another $1,000 an ounce. You just made another $50,000 and so on. So people get the $1,000 an ounce times 50 equals $50,000 in profit. They get that in their heads, and it's real money. I'm not saying it's not true. It is true. But that's how they think about the market. But what a lot of people don't realize, at least not right away, is that each one of those $1,000 increments is easier than the one before because it's a smaller percentage gain off a higher base. So when you go from $2,000 to $3,000 an ounce, that's a 50% gain. That's a heavy lift. That took a while. When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% gain. It's a lot less than 50. Well, just follow that through. When you go from 4 to 5, that's a 25% gain. But when you go from $9,000 to $10,000 an ounce, that's only an 11% gain. So it's just, again, same $1,000, same $50,000 profit, but 11%, that's almost like a good week the way gold's been going lately. So my point is, people are looking at these $1,000 benchmarks, and that's fine. It's real money. But we made it to 5. We're going to get to 6. But you're going to go 8, 9, 10 really fast for the reason I mentioned, which is it's just easier. And then when you go from 19,000 to 20,000, that's only a 4% gain. 4% gain. So that's like a day's trading the way it's going lately. So these benchmarks get easier, and that's why people who watch gold go from 2,000 to 3,000 like, oh man, it'll never get to 20,000. My point is it will, but it could get there a lot faster than people expect.
As gold rises, each additional price milestone requires a smaller percentage gain than the last. A $1,000 increase feels the same in dollar terms, but mathematically it becomes easier as the base price grows. Behavioral biases cause investors to fixate on round numbers, underestimating how quickly higher levels can be reached. What once seemed extraordinary becomes routine. This compounding effect accelerates price discovery, especially during strong demand cycles. The same logic applies to silver, where fixed dollar increments become increasingly achievable, suggesting that future advances may arrive faster than expected.
I think silver is going to continue to go up for a number of reasons. Number one, the math example I gave for gold, it applies to silver also. Now, maybe you can use a $10 benchmark instead of a $1,000 benchmark. But again, going from 90 to 100 is 11% versus going from 40 to 50, which is 25%. So those $10 benchmarks, 110, 120, 130, they just get easier. And so I've got silver going to 200 without too much difficulty, number one. Number two, silver's going to tag along with gold. There's no way gold's going to the levels I expect where silver's not along for the ride. You're not going to have $20,000 gold. We'll get there. It's going to take a while to get to $10,000 gold. We'll get to $20,000 gold. But that's not going to happen without silver going to 200 or higher. So, it's kind of hitching your wagon to the right horse, so to speak. So silver will go along with gold. But there are other dynamics that I think are unique to silver, or at least they don't apply as much to gold. One of them is that silver is a major technological industrial input. Gold's actually not good for very much except money. It's probably the best form of money, but the industrial applications of gold, they're extremely limited, very, very specialized. I visited a number of the biggest refiners in the world, and I talked to people about this. I once asked a guy, he was the head of Argo Horace, one of the biggest refiners in the world. Could he make 5 nines? 4 nines gold is 99.99% pure gold, and there's a process for it. I saw it kind of play out. I said, just out of curiosity, could you make 5 nines? He said, we can, but it's not worth it because it's the added expense and energy inputs and things you have to do to get there don't give you more value in gold terms relative to 4 nines gold. It's just not worth it. Except for certain, he said, ultra thin wiring. If you want that, we can do it, but it's really, really specialized. But basically, coating a space helmet maybe, but basically gold is not good for much. other than money. Silver is different. Silver is used in wiring, electronics, catalytic converters, weapon systems, all this AI, frenzy and building these massive data centers and the processors. That all requires a certain amount of silver. Yeah, other things too. Cobalt and copper, galore, silicon, and rare earths. They're all needed as well. But silver is an input to all that. So silver has a precious metals vector and an industrial input vector. They don't have to go in the same direction. You could have a bad recession and an AI blow up where industrial demand is going down and precious metals going up, or vice versa. But at the moment, they're both going up. The industrial demand is huge, and the precious metals demand is huge. And there are other things going on that are, non-transparent. I hear a lot of rumors. Some of them have some merits, some not. You hear about enormous physical demand for silver that cannot be met or satisfied by paper silver contracts. People who sold silver on paper, they're being called, say, "Hey, deliver the silver." It's like, "Oh, wait a second. I thought we had a trade here. You want silver? Well, that's different. I got to go find it." So there's enormous demand coming from all over. I've heard reports, I can't verify them, that China is hoarding silver. Why would they do that? Well, the answer is what we just discussed. They're trying to beat the U.S. in the AI race. So the open trading relationship between China and U.S. is pretty much off, at least in that sector. Maybe soybeans are moving, but not too much in the AI NVIDIA chip world. So China knows that if they're going to keep up with the U.S. in electric vehicles, where they're probably ahead, AI, they're not ahead, but they're trying to catch up. Military applications, same thing. They're going to need a lot of silver. And so they are hoarding it. They're just buying it like crazy and putting it away in inventory, basically, for future use. And then you do hear a lot. This is another one of those narratives that doesn't hold up to examination. You hear people say, well, the physical longs and silver futures, so COMEX or London Metals Exchange, are massively greater than the amount of silver in the warehouse, and they couldn't possibly meet that demand, and they're going to default. And my answer, at least with regard to COMEX, but the LME as well, read the rule book. I'm a geek, so I've actually read all the exchange rule books, all the major exchange rule books. And the first thing that jumps out of you when you read an exchange rule book, they have a rule that says they can change the rules. So it's like if markets, disorderly is a key word. If markets become disorderly, the Board of Governors can meet, they can issue orders and change the rules as they're understood on a day-to-day basis. So they have a defense mechanism. Number two, they say plainly, and it's on the websites, it's everywhere you look, we are not a source of supply. You should not look to futures exchanges as a source of supply. Now, you can take physical delivery. There is a process for that. There is silver in the warehouse for that reason, and it's really designed to keep the arbitrage between paper silver and physical silver in line, so it keeps everybody honest. But the idea that every long silver contract holder could put in notice and take delivery of silver, it's never going to happen. The idea that that would somehow bust the exchange is not true. What would happen is the Board of Governors of the exchange would issue a rule. They would say trading for liquidation only. That means if you're long, you can pair off with a short. If you're short, you can pair off with a long. Settle the contract. One side or the other writes the check, release the margin, settle it financially, but you don't have a right or even a strong expectation that you can take physical delivery. So all this stuff, there's not enough silver in the warehouse. There's exactly enough silver to meet the demand that they're willing to satisfy. But beyond that, they would just say no deliveries and just pair off your contracts. So you're not going to bust the exchange that way. And people who say that, they're just kind of scaremongering a little bit. But having said that, it is a data point, and one more reason to think that there are scarcities in silver which go above and beyond, I'll call them normal scarcities in the precious metals market. So yes, so silver's got some drivers that are different from gold, but they're all pushing in the same direction.
Silver stands apart because it straddles two worlds, precious metal and industrial necessity. Unlike gold, silver is embedded in electronics, renewable energy, data centers, and advanced weapon systems. The AI and electrification boom has intensified demand just as investment interest is rising. This dual pressure is unique. While futures markets manage price discovery, physical availability remains tight, reinforcing underlying scarcity. Though exchanges can settle contracts financially, persistent physical demand still matters. Together, these forces position silver to track gold higher while also benefiting from technological growth that gold simply doesn't share.